welcome to the Capital Discussions at QuantyCarlo Education. This is Tom Nunemaker with Larry Richards, and before we get started, quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, Larry, nice to have you back while I change screens to you. So
Okay.
what's new with QuantyCarlo? I know we have the data viewer that came out.
Yes, the data viewer came out. For those of you who haven't seen it, let me crank it up here and see if I can give a demonstration. Let's see here.
And don't forget to share your screen.
Oh, I'm not sharing my screen yet, am I?
Nope.
Okay. Let's see here. There we go. Share my desktop.
Yep, it's loading. Okay, see it. Google Japan.
So wonderful. Here we go. This is viewer.quantycarlo.com. I go here. Let me just go off to another screen to log in. So this is essentially the data viewer. Let's see, go ahead and save that. And we've, based on user feedback, we've made a few modifications and continue to enhance this. And here's the way it works. Basically, you just put in something like SPY, and voila. You can see here that we now have, I'm choosing the number of strikes that I want to see. This is a new feature. If I want to see just 4, I get the 4 at or closest at the money strikes. So whenever you have a lot of strikes and you can't see them all on the screen and you don't want to scroll, then you can just select 4 or 8 or 16, or you can select all if you want. And basically this allows you, because I have a low resolution setting right now, I'm going to leave it at 4 strikes. And then you can essentially step back in time. You can choose the year. One of the things that I'm asking my developers to fix is that right now you can go back to like 1950, which is not very useful. So in this case, I'll go back to like 2007 and click here, pick a time of day, and then click out here somewhere, and I can go to that particular day. If that day happens to be a market holiday, then it will just go to the next, automatically go to the next trading day. So this allows you to view essentially the mid, the IV, and then whatever Greeks you want. So if I wanted to add theta here, I can do that. And then likewise, I can choose the expiration cycle. If I want to see the weekly expirations, then I'll see those, and you'll notice that I think you should be able to scroll left and right. No? Well, if there's a lot of expirations here, then you'll be scrolling left and right. Now, you can also just look at the quarterly expirations. It's not detecting any quarterly expirations for this symbol.
Oh, did they have quarterly options back in 2007?
Yeah, maybe not. Let me switch over to monthly. So there's monthly. Anyway, so this is a tool. It's pretty much in beta right now, but it's usable. So we welcome everyone to make use of it. It's free of charge, and give us any suggestions for what you think would make it more useful. Okay.
Yeah, there's actually a link I put in the chat, QuantyCarlo.com/feedback. If you have any feedback on the data viewer, and that's probably a link that should be on that page somewhere, then you can just fill in whatever feedback you have, and it'll go right to the right people.
Okay. Super. Likewise, we've got a few things coming up, like there's something that's in progress, but I'll just go ahead and share it with you anyway. Cookbook.QuantyCarlo.com. This is where we're going to put a number of recipes. One of our more advanced users, Jim Adams, is actually authoring this very kindly. And yes, and it is great. And so you can see, for example, here's one standard deviation down day if you want to use a pre-entry rule or entry rule that's following a one standard deviation down day. Well, here's the recipe of how to do it. And this will be, of course, populated, and it will grow in content over time. And so that we're looking to beef up the help materials, not just the tutorial videos. Tutorial videos have been sort of on hold for a while because of other higher priority things, but still we're adding things like this along the way. Some other news that I'd like to share are that we have some new features. One of the features that is available right now is the trade log. And let me just show you what that looks like. Let's see here. We've got an example. Let's see here. I'll just show you in here. We have, this is a directional trade that is we're doing together with one of our customers, and let me show you the trade log is here. And essentially it's whenever you export to Excel, you're going to get a page that looks like this, where actually the color scheme here is not very easy to see, or it's not very printer friendly. So we're actually we're making it simpler in a very near-term update of the QuantyCarlo software. You will get a much simpler color scheme. That's the job results. This is essentially the summary report, as well as the table of trades, the trade list, and so all of that goes out to Excel. But then you've got a second spreadsheet that essentially says, okay, what did I buy? What was the commission that I paid? What was my fill price, for example? And in this particular transaction that happened on this particular time, on this particular date, what was my net cash flow? And here you have that. So I sold this one, I bought this one, I bought this one, I bought this one, I sold this one, all as one transaction, and you can see the individual fill prices, like I said, and then you see the net cash flow for that transaction. So this is a useful bit of information for debugging to see if everything is happening the way you like. Now, in addition to this, if you're using variables in your trading plan and you want to see how did my variables change over time, well, we have this variable log. And if you look in here, you'll see the name of the variable and the value that was assigned to that variable. Now, right now, this is incomplete. Very, very soon it will be complete. The thing that's missing right now is that you don't see the assignment to the variable assignment actions that happen during a trade. What you see is the initial value that's assigned at the beginning of each trade. So like this is the beginning of one trade, this is the beginning of another trade. So it doesn't really show you yet how those variables change throughout a trade. And that's something that you'll be able to see as soon as this is deployed in the very near future. Just wanted to share that with you as something that's coming soon. And let's see here. Play. Okay, so that's the trade log and the variable log. In addition, we have, let's see, trade playback and speed enhancement. If you use trade playback, you probably will notice that it's faster now than it has been. Whenever you generate, for example, the playback of a trade that may be, let's say, 40 days in the trade or some lengthy trade, you'll notice that the playback data is considerably smaller because we've done some compression of the data. The T+0 curve is actually compressed now into rather than send each point, we send an algorithm to actually for the client to draw the T+0 curve. So that's made it a little bit, it's made it faster. It reduces the data size that's sent to the client. So that's an enhancement. Then another thing that's coming soon, this is actually already implemented on the server and we're testing it out with some of our customers, and that is an external event list. Now what is an external event list? Well, let's say you've got some kind of signal that you're getting from an external system, let's say AmiBroker or TradeStation or some other system that generates trade signals. Maybe you're using Ichimoku, or maybe you're using Bollinger Bands, or just whatever you're using. What we can do is we can import that as a list of events, and then we can trade in QuantyCarlo off of those events. And essentially what we do is we have it's a CSV file, we've got a date column, and we've got a time column. The time is optional if you want to use it. If you don't want to use it, you don't have to. And then after that, you've got like variables. Like, for example, you might have a buy signal, in which case you would have a variable named buy. And then you have a sell signal, maybe, and in which case you would have a variable named sell. And then you can put either true or false, and you can spell them in any way you want. You can put like lowercase or uppercase, doesn't matter. You can have mixed T, like TRUE if you want. We'll ignore that. Or you can say if you want to have 1 versus a 0, you can use that as well. So now on a date when there is no signal, you just don't even have to put the date. You just put the date of the date on which there is a signal. And so the date list can be as short or as long as you like, depending on how many signals you have. Now this is especially for directional traders. For let's say direction neutral traders, this is not necessarily of so much value, but we found that there are a lot of people who are strictly directional, and this is quite useful for them. So please stay tuned, and we'll have this coming in a short while.
Yeah, I think that's a really neat feature, even for directional traders. You know, if you want to lean a little short or a little long based on a signal, you could actually do that.
That's right. You know, we do have some support in QuantyCarlo for creating your own directional signals, but we haven't really fleshed that out yet. So, for example, if I wanted to create, I think last time I showed Bollinger Bands, but if you look here under underlying asset, right now we've got indicators here. We've got simple moving average, exponential moving average, simple Bollinger Band, exponential Bollinger Band. Those are the only 4 we have in here at the moment. We'll have some others coming soon. Another thing that's coming soon is some people have said, you know what, we want to know not how many days to expiration, which we have here actually in for example, the option chain. We have expiration 0, which is the front, and expiration 1 is the back. We have time to expiration in days for both the front and the back. Well, some people have told us that, you know what, we also want to know how many days from expiration. In other words, the most recent expiration, how many days ago was that? And so based on that feedback, we're implementing the days since previous expiration. So you can enter a trade based not only on the days to expiration, but also the days from expiration. Now, for some people that may not be important, but for some people it definitely is for some types of trading plan. So that's another thing that's coming up. Okay, let me see here. So today I was thinking that, you know, lately we've been going over mostly directional trades. I was thinking we might go over a direction neutral trade. But before we do that, actually last time there was a question that I couldn't answer. So let me go back and answer that question. The question was, what if I want to know the IV of a particular strike, right? Or some other attribute of a particular strike? How do I get that in QuantyCarlo? And I couldn't answer that last time, so let me show you exactly how to do it. So what we have is we have option chain over here. And the option chain has option chain attributes. Now, let's go into the front expiration. And notice that we have strike attribute, okay? So the option chain, front expiration, strike attribute. Now, what sort of attributes does a strike have? Well, it has call implied volatility, put implied volatility, it's call Greeks, put Greeks, etc., etc. You can get the call premium, the extrinsic value, intrinsic value, put premium, put extrinsic value, etc., etc. And you can even have custom option attributes if you want. For example, if you wanted to create something like theta to delta ratio or something like that, you can create that and put that will appear in this custom option attributes list. But that's kind of a digression. The thing is, well, how do you get this strike attribute? Now, let's say if I want to know the call implied volatility of a particular strike. I'll just drag this over. This is a number, so I drag it onto a numerical expression, and then this dialog pops up, okay? So I've said I want it to be in the front expiration, and I want to get the call implied volatility, but what I haven't told it yet is which strike. So that's where the strike selector comes in. I need to go over and find a strike selector. I happen to have a few here, so let's say I want my, since I'm asking for call implied volatility, let's take the strike with call delta as close as possible to 15. Okay, So I can just drag this over here like so. And now, if you can look at the English language version here, and it tells you exactly what it should mean. Get strike attribute front call implied volatility using strike selector with nearest expiration as front. So that's a little bit maybe cryptic. Maybe we can come up with a better English language translation for that, but I think you can see how it's done. Once again, whatever strike attribute you want, all you have to do is give it a strike selector so that it knows which strike you're talking about, whether you're in the front or the back, expiration, and what is the attribute that you want. And give it a strike selector. Okay, so that is the answer to the question from last time that I couldn't answer. Let me now go on to this direction neutral trade. So I've actually been playing around with it this morning. It's morning for me, even though it's evening in the East Coast of the U.S. But so I've been playing around with this a little bit today and adding some adjustments. I don't know if we'll get as far as the adjustments today, but whenever you do adjust a trade, this is an iron condor. Let me blow it up a little bit so you can see. And whenever you add adjustments, you can actually see them here. So here I have this adjustment buy protective back month put. And here I've done another one, here I've done another one. And right now I've got those basically whenever my position delta, no actually, sorry. The way I'm triggering those is actually I'm looking at my short put. And if my short put delta goes above a certain amount, so you can see my short puts over here. Let's raise that up a little bit. You can see my short puts. I've got, let's see, at my 152.5 strike, I've got 4 short puts here. You can see that my delta now is 27. Okay, so that is actually I think I put 25 as the trigger for adding a back month protective put here. But I'm getting a little bit ahead of myself, so let me go back to the very beginning and talk about how we want to think about this trade. And then we'll start putting it together. And maybe we won't get all the way to the adjustments today, but we can continue it next time. So this is my direction neutral trade. And what I'd like to do, it helps to actually write these down on paper before you actually start putting them into QuantyCarlo, because then you have a clear idea of what it is that you want to accomplish. If you start putting the trading rules into QuantyCarlo before you know exactly what you want to achieve, then sometimes it can be a little bit confusing. So let's see here. What I'd like to do is I'd like to have an iron condor. And the shape will be something like this. And I'm going to have a short put. So I've got this is my short call, -1 call. And I've got a short put over here, -1 P. And I've got my long, +1 P, and then +1 C over here. So I've got a put credit spread over here, and I've got a call credit spread over here. Now, first thing that I want to decide actually is what delta am I going to use? And I'd like to use a delta of, let's see, let's use a delta of 15. Actually, I think the 14 is what I used in the one that I programmed today. So I'll use 14. Actually, this is the absolute value of put delta. Put delta is always negative, so I take the absolute value and I use 14 here. Actually, it'd be 0.14. So this is the way that will look. Now, what do you think the, just looking at these two delta values, what do you think if we do nothing, if we do absolutely no adjustments to this condor, what do you think the win probability is going to be, the win rate? What do you think the win rate is going to be? If I just do no adjustment whatsoever. Anybody have an idea? I don't see the chat window.
Nobody has anything in the chat yet. I would think it would be a little bit, let's see, 14, 28. So it'd be a little bit better than just the short strikes, because you have actually, you know, the expiration break even is beyond those.
Right. So exactly. So essentially the probability of going higher than this strike is 14%. And the probability of going lower than this strike is 14%. So that's your probability of losing, right? Yeah, exactly. So it's about 70%. So we've got about a 70%. We can expect, without any adjustments at all, a 70% win rate. Now, that might sound pretty good, but what's the, okay, Ralph says that the expected value of this trade is negative. I would agree. Now, what is the factor that we're ignoring here? The factor here, the factor that we're ignoring, see, win rate is only one part of the equation, right? Exactly. Well, win-loss ratio is the win rate, and then you have the risk-reward, right? Risk-reward. So if I do absolutely no, absolutely no adjustment, the thing is my break-even point is going to be somewhere up here, right? So this is my reward, right, which is my credit, and then this is my risk here, and you can see that my risk is much bigger than my reward. So whenever I win, I'm going to win a small amount, even though I'm winning at 70% of the time. But whenever I lose, I'm going to lose a large amount. So let's go ahead and see what happens. We would expect this trade to lose money without any adjustments, without any management. It's going to lose money. But it's going to have a high win rate. Okay, so let's put it into QuantyCarlo and see if our expectations are confirmed. So I have here a low prob iron condor plan. I'm going to save this as a under another name. Let's say no adjustment. Okay, voila. Let me close some of these windows here. Okay, so I have one. Didn't I just save it? Yes, I did. I saved it as low prob iron condor, no adjustment. So now I'm going to remove this adjustment. I've got enter low prob iron contour, and then I'm just going to let it go to expiration. I'm going to let it expire. So let me save this, and let's take a look at what happens. I'm going to use M and X as my underlying here. And let's see, I'll use this account here. I think it starts with $10,000. So this is LPIC, no adjustment. So let me submit that. Do you want to save? Yeah, go ahead. So our expectation is this is going to give us about 70% win rate, but it's going to lose a lot of money because the risk reward is pretty bad. The risk reward ratio. So this is just a baseline, and we're confirming that, okay, what happens if we don't manage this trade? What are the baseline characteristics of this particular trade? By the way, one thing I didn't point out is that I'm using 10-point wings. So the distance between the shorts and the longs is $10. Okay, there we go. So we started with $10,000 and we lost more than half of it. We have a win rate of 73.45%, so that's pretty much what we were expecting. Our average return was a loss of $50, okay? And so our confidence interval goes from minus 230 all the way up to 128. So that's our expected value would be somewhere in between there, and since this negative number is much larger than the positive number, then that sort of is consistent with the results that we got over here. Our peak risk was $4,000. Our average risk was $3,500. Our return on average margin was minus 1.4% per trade. So let's go in and take a look just for the heck of it. We can sort by profit and loss. If I sort by profit and loss, these are my winners up here, and these are my losers down here. Let's take a look at one of these losers. They're all in the trade 34 days because we didn't manage them. Some of them are 33, some of them are 31. Those must have been holidays that we that delayed entry. But essentially my entry window was, I think, between 35 and 30 days to expiration. So let's take a look at one of these and see what happens. This is, I'm losing money. Am I losing money on the upside or the downside? Let's see. All these, the underlying price went up. Okay, so let's take a look at one of these where we lost money and the underlying price went up. And this will give us a clue as to when we might need to adjust. Okay, so here we are. You can see that the underlying price went up. Now our position deltas here, I've got 4 contracts per leg. Okay, so you might wonder, okay, what is a good position delta to start thinking about adjusting? Well, this should give us some feedback here. So that's looking pretty precarious to me. We're already down $352, plus we've got a negative delta of 103. That seems like a fairly good time to adjust. Now let's take a look at where our short deltas are over here. My call delta has gone to 35. So if I were adjusting based on my short call, I would say that, you know, sometime around or before when my short call reaches 35 delta, I probably want to take some corrective action. Now, otherwise, if you're adjusting based on position delta, you could look over here and say, right around minus 103, or somewhere around there is where I want to start thinking about adding an adjustment rule, right? So this is just a little bit of, I think, baselining that I use when I'm designing a trade and I want to figure out when is a good time to start adding an adjustment rule. Okay. Let's take a look at the same thing, but on the put side. Let's see where the market is going down. Here's one where the market is going down, so we can get the same sort of sense of when we need to adjust on the put side. Okay, so same thing again. Now it looks like right about here, I think it's probably too late, right? And this would also indicate to me that maybe end-of-day data is not going to allow me to adjust in time to see, because the day before I was in pretty good shape. My delta was 25. My position delta, see here, is 25. Well, that's not too bad. And my P&L is minus $5. But suddenly the next day, because I'm using end-of-day data here, I've already lost more than $1,000. And my position delta is way up to 90. And you can see that I've already I've blown past my break-even, my expiration break-even. I've even blown through my my short puts over here. So in reality, you know, right now I'm just kind of baselining this trade as I think about how to design it. In reality, once I get down to actually testing this thing, I'm going to want to use intraday data. I'm going to want to use 15-minute data because clearly, I mean, I think this shows very clearly that end-of-day data in this case is not going to allow you to prevent this massive loss and prevent this the damage that's going to occur whenever you get a really big move like you got on this date. Now, this one, as you can see, continues to go farther and farther until finally we basically lose as much as we could possibly lose, which is about $3,300. Our margin was $3,300. We lost $3,300 plus commissions. So there you have it. Those are the basic characteristics of this particular iron condor. Now, what could we do? as an adjustment. Why don't we add a protective put in the back month? So what I've done is I've said over here, I've created an expression, need to add protective put. And let me show you what that looks like. I've got my short put delta is greater than 0.25, and that's absolute value. Let me show you what that looks like. I've just done absolute value of short put delta is greater than 0.25. Okay, so whenever it exceeds 0.25, I want to adjust. Okay. Then I've also added this thing here, protective puts less than threshold. I don't want to do this too many times. Let me show you why it's probably a good idea not to have an unlimited number of any particular adjustment. Okay. So right now I've limited this to three adjustments, but let me take it away. Or actually, what I'll do is in my adjustment rule, I will modify it. So buy protective put is my action. Okay, I'm buying one protective put, and my rule, which uses this action, is down here, buy protective put. So whenever need to add protective put, okay, so what I'm going to do is I'm going to modify this so that we don't have any limit. So that we'll just to see how many times we end up adjusting. I'm going to save this, buy protective put, back month, no limit. Okay. And that will be our adjustment rule. Takes a second for it to appear here in the list. There we go. Okay. So what I'm going to do is, rather than use this expression, I'm going to say, okay, short call, short put. There we go. So when this happens, in other words, short put delta is greater than 0.25, I'm going to buy a protective put in the back action. And then I'm incrementing my protective put counter here, but I don't really need that anymore since I'm not limiting. So I'll just save this. Let me put it into my trading plan. I've got it. I'm calling it no adjustment, but I'm going to add an adjustment here anyway. Okay. So we'll see if this helps us at all. Now, obviously, we're only doing one scenario, which is a bearish scenario. We're not helping ourselves at all yet on the upside risk. So it's just one incremental step on the way. Now let's run this and see what difference it makes. Do I want to save this? Yeah, I'll go ahead and save it. So obviously, if you're going to start buying protective puts, at some point you're going to want to sell them for a profit. If the market keeps going down, then they're going to increase in value. At some point, you're going to want to sell those for a profit, and then use that credit to do some other corrective action, like roll your put spread down, which is actually my next step. And when I roll my put credit spread, I'm just going to reset that counter on the number of puts that I'm buying, protective puts that I'm buying. And that can be a parameter for optimization. How many puts should it be? Should it be 1? Should it be 2? Should it be 3?
Hey Larry, do you want me to promote everybody to panelists so they can ask questions?
Sure.
Okay. Now you'll see a dialog box pop up. You don't have to call in if you don't want to. You can keep using audio broadcast, but if you'd like to participate, you can call in with the phone or your computer.
So I think we're getting close to our time limit today, and so I think we won't get much further on this particular strategy, on this particular algorithm, but I'd like to continue it next time, and so that we can see, from beginning to end, how you would go about designing a trade like this that's fundamentally not profitable, but through some judicious adjustment rules and adjustment strategies, you can actually make it profitable. And then once you've made it somewhat profitable, then you can go ahead and start optimizing the different parameters and find out what is really the optimal set that makes it optimally profitable, gives you the greatest expected value. Now, once again, no big surprise, we're still losing a lot. We've lost more than what we had in our account. In fact, we've gone very negative.
That's not realistic, Larry. Nobody ever does that.
No, of course not. No.
Not more than once or twice.
Yeah, no, this is not one that we're recommending, okay? So, but let's go in and do like we did a second ago. What will be interesting is to see, okay, how many times did we adjust, and did the adjustments help us? Well, here's one where we adjusted 18 times. Did those adjustments help us? Apparently not, because we lost $2,000. Well, let's take a look. It's not a big surprise that these adjustments didn't help us. Because
since we never bought them back, we sold them.
Never sold them back, yeah.
Yeah.
So essentially, we've got this basically a bunch of long puts that are protecting us. Okay, I must have bought something from Apple because they tell me that my receipt is here. Okay, so here I am. I hit my adjustment target. I bought a long put, hit it again, bought another long put. The market must be going down. Okay, I'm actually, and I'm controlling my losses here a bit so far. I'm down to 334, which is not bad given that the market is on a big downturn. So essentially what I've got is a bunch of long calls that are just overwhelming the entire position.
Long puts.
Long puts, thank you. Yeah. So if the market were to keep going down, then I would do well. But the problem is, it doesn't continue to go down. And then this kind of makes me wonder whether my threshold for my short put is actually good, because I keep buying these long puts, but they're being triggered not off my position deltas, right? Which actually, if I were to look at my position deltas, I would say, I shouldn't be buying long puts. I should be buying long calls. So every one of these long puts is actually making my position deltas worse and worse and worse on the minus side, right? So this, looking at this put delta, the short put delta, and letting that be my only adjustment criteria is clearly not a good strategy. I also probably ought to look at my position deltas. Look at that, because I've let them just blow up. Now they've gone like way down, minus 500, way out of whack. All right. But here's just an extreme case to show you that, well, that might have been a good idea to protect myself in certain circumstances, but it also has negative side effects. So I need to go back to the drawing board, and I need to think about, what is a more clever way to actually protect myself? And I think one thing that comes to mind straight away is that, you don't want to do this more than a few times. Maybe up to here, I've done it twice. It seems to be protecting me okay. But maybe on the third time, maybe what's better to do is that rather to buy another long put, maybe I'd better sell my puts, take my profit from the long puts, and then use that profit to finance the rolling of my my credit spread, because my credit spread is what's hurting right now. My credit spread is really losing money. Where did I buy my puts? Or where did I sell my puts? Okay, I sold my short put at $1.45. Okay, where is it going now? It's like $3.45. Okay, so this credit spread is really hurting. Now look at this. It goes up to like 490. I think at one point it was like 545. So I'm really hurting on my short puts. So I need to do something about that, and I can do that by rolling the whole credit spread. And look at my long puts, my long back puts. Let's see, where did I buy them? At the beginning, I'm buying the long put for 610, and then let's see, it goes down, goes up in value to $8, it goes up to, it was $7. Anyway, it's profitable, so I should be able to use that profit to help me roll my credit spread. And I think we can pick up there next time how to use that, how to count the number of the adjustments you've made so that you don't make too many, and then how to take that profit that you've made from your longs, your protective longs, and use them to finance a roll. So I think we can pick up there next time. Any questions or comments? Does this make sense as an approach?
Yeah.
Cool.
That's some things I can go play with.
Yes, it's fun, and if you look at it this way as a kind of an iterative approach, sort of an interactive way interactive tool to design strategies and optimize them. But it's a lot of effort. But after the good news is that once you've gone through this process and you've got your algorithm encoded, then you can just tweak it. And then tweaking something is much easier than building it from scratch.
Until it blows up.
Well, we hope it won't do that.
No, the market changes.
Right. All right.
Very good. Very.
Thanks a lot, Spencer. This is Spencer speaking, by the way, isn't it?
Yes.
Okay. Great to hear your voice. All right.
Looking
Yeah,
forward to see.
a good walkthrough and demo. Thank you very much.
My pleasure. Thank you for joining us.
Okay, so I guess, like you said, this is probably a good place to take a break, and we'll come back again in 2 weeks and pick up from here. I would guess if anybody watching has any questions or maybe has something you'd like to cover next time, what would be a good place for them to send their request to support at QuantyCarlo.com?
Yes. I believe we have info at QuantyCarlo.com. Do we? Also,
I believe so, yeah.
Support is a good one. Support at QuantyCarlo.com is a good place to send.
Might also
Okay.
be nice to see it on the forum.
I'm sorry?
I said it would be nice to see it on the forum where we can all kind of add our 2 cents.
Oh, yes. Okay.
Yeah, so we can have a forum post with a link to this video and then ask for suggestions or requests for the next one.
Well, that's a good idea. Question from Jay. Is it possible to provide a package of predefined strike selectors and adjustment rules that would provide a baseline to start to work from? Yes. I mean, that is very, very possible. I think over time, that's our ambition to build up different libraries of components that can be just reused so that people don't have to create them from scratch. But the question is, how would we organize that? I'm not. The thing that I'm struggling with is how is the most intuitive way to organize those libraries, but we'll think of something. If you have any suggestions of how you think they should be organized, then please let me know.
Okay, good suggestion. All right, everyone, thanks for staying with us to the end. Really appreciate it. And yeah, Jay, great idea that users could contribute to the library. I think that's kind of the long-term goal, right, Larry?
Yes, definitely.
All right, well, I'll go ahead and end the meeting, get this posted in the forum, and we'll get ready for the next one in 2 weeks.
All right. Thanks a lot. Thanks a lot, everyone.
Thanks, everyone. Night.
Bye.